Hi, I'm Michael Yardney. At the end of each year, I like to look at what's happened in the year gone by, and I like to describe the property market, put a label on it, and I was going to call 2014 the year of the property investor. The year finished with property investors taking up about 50% of all new loans. That's the highest percentage on record, and many investors had a great year. Australia's property markets enjoyed a positive 2014. They were buoyed by strong population growth, by historically low interest rates, by a voracious appetite for capital growth by investors, and by a desire of overseas investors to place their money into Australia's large capital cities. However, not all investors did well. I've heard many complain that the property boom passed them by. This was because our markets last year, in 2014, were very fragmented. And if you didn't own the right property in the right location, you probably didn't enjoy significant capital growth or rental return. Clearly the outstanding performance for 2014 were the Sydney property markets, which increased by about 13.2%, and the Melbourne, where property values rose 8.3%. Over the year, home values were about 6% higher in Brisbane, as well as rising in Hobart, Adelaide and Canberra, and Perth and Darwin had a minimal rise. But now, the impact of those really low interest rates, the lowest interest rate in 60 years, seems to be dissipating, and price growth peaked in the middle of 2014, and now it's moderating and is very likely to be much lower in 2015 due to lower economic growth, rising unemployment, ongoing job security problems, lower consumer confidence, and sluggish housing income growth. There are still some positive factors that are going to affect our markets next year, but there's also going to be some stumbling blocks and I guess some potential landmines along the road. So let's firstly have a look at what the big picture overview, what I think is going to happen over the next year or two, and then maybe we can look at a couple of ways to protect yourself from the turbulent times ahead. First, let's look at the good news. I still see quite a lot of positive factors for our property markets, our housing markets in 2015. This includes the continual population growth in our capital cities, albeit there's going to be a lower growth this year. According to the Australian Bureau of Statistics, Australia's population is growing by one person every 77 seconds. It's driven largely by immigration, overseas immigration of course, but this means our population is growing by around, I don't know, about 400,000 people a year. Of course, many of these want to live in the same big capital cities, particularly Melbourne and Sydney where the jobs are, which means demand is likely to outstrip supply in our middle and inner ring suburbs of the big capital cities. Interest rates are also going to remain low for most of 2015. That's another positive, and it's quite possible they're going to have another fall or two. At the same time, banks are continuously aggressively chasing new business, meaning more people are going to be able to afford to enter our property markets. Another positive factor is that confidence in the property markets and the feeling that people have missed out, whether as a homeowner or as an investor, will mean more Australians are going to try to get a foothold onto the property ladder before prices increase further, or before borrowing conditions become less favourable. And I see another positive factor with overseas investors continuing to keep looking for a safe haven for their money and investing in Australia. The low Australian dollar is likely to encourage overseas investors to keep ploughing their money into the new and off-the-plan markets. This is going to continue at a time when we've already got an oversupply of those properties, particularly in Melbourne and Brisbane, and this is going to keep inflating the value of CBD prices. And there's also going to be what I call the wealth effect kicking in next year, particularly amongst existing owners in Melbourne and Sydney who are going to feel better off because the value of their homes has risen significantly. Some are going to use this extra equity in their homes to invest, or others may be using it to move their home. And I can see self-managed super funds buying property, especially in the first bit of 2015, while the government contemplates removing the ability for self-managed super funds to borrow. That was recommended recently by the Murray Inquiry. And as the year goes on, I think a locally improving economy in the second half of 2015 is going to give a resumption of consumer confidence. That's the good side, but there are some potential stumbling blocks. It's not all going to be rosy. I see consumer confidence falling in the first half of 2015, which has to have a negative impact on our property markets. The fact is, Australians are going to keep hearing negative news about the problems of the world overseas, about China's economy slowing down, about Europe's economy being a basket case, about deflation around the world, about wars. Locally, I can see we're going to be worried about rising unemployment, about a weak economy, about a government that can't deliver its budgets. I think this is going to mean that the media is going to have a field day with negative commentary, and the average consumer, they're just going to keep their hands in their pockets and not spend, particularly on big ticket items like upgrading their homes or buying investment properties. Now, every year there's some X factors. Economists refer to an X factor when an unforeseen event or situation blows out all those carefully laid forecasts. Every year we get lumbered with an X factor or two, comes out of the blue to surprise us. Now, potentials for 2015 include APRA introducing macro-prudential controls, things that are going to limit investor finance, or maybe the changes to self-managed super funds being able to borrow to buy properties, as was recently recommended by the Murray Inquiry. But most likely it's going to be an X factor we don't know about. Otherwise it wouldn't be an X factor. Now, I'm not talking in riddles. We have an X factor virtually every year. So be prepared. So what should an investor do? Firstly, be careful. Lower overall capital growth in 2015, more in line with the rises in wages and disposable income, means investor mistakes won't be covered up by strongly rising markets. Remember Warren Buffett's great saying, "A rising tide lifts all ships, but when the tide goes out, you see who's swimming naked." However, I see falling consumer confidence and lower buyer demand for properties in the early part of 2015 as a potential opportunity for investors who've got a long-term focus. Remember what Warren Buffett said also. He said, "Be fearful when others are greedy, and be greedy when others are fearful." In other words, there's likely to be a window of opportunity for property investors who've got a long-term focus, an opportunity for them to take advantage when others are going to sit by the sidelines. So where will those opportunities be? Clearly, our property markets were fragmented in 2014. They performed really strongly in Sydney and Melbourne, while other regions languished. In fact, they were more fragmented than that, with only certain regions in those two big capital cities performing strongly. Now, I see this trend continuing into 2015 as property markets in new home buyer locations, blue-collar areas, regional Australia, they're going to underperform in line with a weaker economy, rising unemployment and jobs uncertainty. On the other hand, there'll be a large group of Australians who are still going to have rising disposable incomes because they work in the type of industries that are still going to be growing strongly. In general, these people will be working in and living in the middle and inner ring suburbs of our capital cities. In my mind, these are the property locations that you should be looking at because they are still likely to perform well in 2015. But be careful, some strategies won't work in 2015. This will include hotspotting. In other words, looking for the next get-rich-quick location. Of course, that's never really worked, has it? The landscape is littered with casualties who invested in previously touted hotspots, like Mandurah, like Moranbah, like Port Hedland, like Gladstone, like Cairns. And you shouldn't invest in generic apartments in high-rise off-the-plan projects. There's already an oversupply of those, and it's going to get worse in the big capital cities. Lack of capital growth and rental growth will make this type of property a very poor investment. The other area I'd avoid is buying house and land packages now to suburbs. These typically first homeowner locations are likely to underperform as many people living in these locations are already struggling. They're having a bit of difficulty managing their mortgages, and they're likely to continue to do so as our economy stumbles and as wages growth remains low for those sort of areas. I'd also avoid buying properties in regional Australia where economic growth will underperform the powerhouse economies of our big capital cities. And of course, buying properties in mining towns where investor demand has waned should be avoided, but I think most of you know that by now anyway. So how can you maximise your profits in 2015? Personally, I've actually taken advantage of the opportunities the property market has presented me. I've had a great 2014 adding to PAM in my portfolio. I've purchased a significant number of properties. I intend to continue to do so in 2015. But to make sure my properties outperform, I use my 5-stranded strategic approach. Firstly, I only buy properties that would appeal to owner-occupiers. Not that I'm planning to sell to them, but because owner-occupiers are going to buy similar properties, pushing up the value, local real estate values. This is particularly going to be important in 2015, where I see the percentage of investors diminishing. I'd also only buy properties below their intrinsic value. That's why I avoid new and off-the-plan properties where you've got to pay a premium. The third strand is I buy in areas which have got a long, strong history of capital growth, but are going to continue to outperform the averages because of the demographics in this area. That's going to be where owner-occupiers are going to want to live because of the lifestyle choices, and ones where the locals will be prepared to and can afford to pay a premium price because they've got high disposable income. In general, these are the more affluent inner and middle ring suburbs of our capital cities. The fourth strand of my five-stranded approach is to find something unique, different, something with a twist, something scarce. And finally, I'd look for a property to which I can add value, to manufacture some capital growth through refurbishments, renovations and redevelopment, rather than waiting for the market to deliver me capital growth. So in conclusion, it's likely that 2015 is going to be a difficult year for some property investors. However, I've noticed an interesting phenomenon. Some investors do well in good times, and they continue to do well in difficult times. On the other hand, some investors do poorly in good times, and even worse in bad times. Now that's interesting, isn't it? So what's the difference between these two groups of investors? And you know what? It's not what most people think. Sure, knowledge is important, but that's not enough. Successful investors are financially fluent, they've got a good team around them, they treat their property investments like a business. By that I mean they hold themselves accountable and they regularly review the performance of their portfolio. But most importantly, they've got the right mindset. I hope 2014 has been kind to you in all aspects of your life, including property investment, and I wish you even more success in 2015. What I've tried to point out in this little chat is that there are some risks ahead, but the real risk is what creeps up on you when you think you've covered all the risks. So let's see what the X factor for 2015 is going to be.